All right, well, we know we're close to reclaiming new highs on the S&P 500, but where do we go from here? Our next guest says higher, crossing 5,000, not stopping there. He thinks the S&P can trade at around 5,200 over the next year, ending in 2024. John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management, joins us now. And John, we've had you on the show multiple times, and you have been bullish, and that looked like a precarious call at times, right? When we saw this sharp pullback, you held true, and here we are poised to end the year at record highs. What was kind of key and germane to your optimism in 23?
Well, thanks for having me on the show, Amber. A key really has been, it's been the fundamentals, and deriving the fundamentals or describing them essentially as revenue and earnings growth for the S&P 500, evidenced in the third quarter to be particularly surprising on the upside, which we thought was terrific. In addition to that, a Federal Reserve that has remained, as it has raised rates and now been in a period of long pauses or skips during a rate hike cycle, has been remarkably sensitive in terms of how its practice of its mandate to contain inflation and provide a good economy and a good job environment in the U.S. It has been remarkably sensitive, so it hasn't pushed the economy into a recession. On top of that, a strong consumer, I would rather say a resilient consumer, and businesses which have shown the ability to navigate times that can be challenging when you're in the middle of a Fed funds hike cycle. So those many reasons that have kept us bullish, and we keep an eye on the fundamentals here and incorporate all those factors.
Now, again, to 5,200, that would be new record high territory. But when you math it out, you're really only calling for a 10% rally, right? So a little bit more of a subdued rally compared to this year. And on that, look at the past 5 years, the years we've seen gains, it's been much more than that, right? So I hear your point that it's a record high, but not as maybe enthusiastically in terms of getting there, in terms of total return.
Well, we would say what we're looking at is right-sizing expectations. So a recognition that stocks don't go up in a straight line. Generally speaking, they can climb a wall of worry. And as such, we recognize the fact that there are considerable uncertainties left on the landscape. And we've got a presidential election. We've got geopolitical conditions which have been exacerbated, and expectations that growth in the fourth quarter, this current quarter, when we look back at it, will have been slower than the growth we experienced in the third quarter, where we saw GDP at 5%, and we saw four sectors of the S&P 500, including tech, consumer discretionary, communication services, and financials, posting double-digit earnings growth. If we see all that slow some, it's important to recognize that we could see some take back early in the new year or at some point in the first half. But that said, the overall trend looks higher, and we do reserve the right, of course, to raise our target should it be surpassed.
I want to underline the target is one thing. The question about how we get there is another. A lot of this year has been on the back of a narrow concentration of stocks, though I understand recently that has started to broaden out. Does that broadening out carry the day? Is there a rotation from, quite frankly, some of the worst performing sectors, which we've seen, they've started to become the best performing? Do you think that's what carries the day next year?
We think it's a combination of the two that carries the day next year. It includes improved performance among the cyclical stocks, some of the growthier value that hasn't participated in this. Even some of the defensive sectors, will have a day perhaps in this rally. But overall, we do expect that technology will be a key component in this. Because of where technology is today in terms of the timeline of development of technological trends that change the way both business and the consumer operates or lives their lives, so to speak, being with technology deeply embedded in business and in the consumer, expectations are that it will help drive growth in all the other 9 sectors, because you've got information technology and then there's communication services,
Yes.
which is about 50% technology in itself, which would tell you that these are areas that should be able to make a value story, a better value story, if managements embrace technology to improve efficiencies. And similarly, in GARPier or growth at a reasonable price growth, companies that embrace technology should also be more attractive to investors. So broadening of the rally, but not an abandonment of technology in any way. We can't imagine that.
So then where do high dividend yielding stocks that have been beaten up, but that can screen defensive, like telecom, like real estate, like utilities, do they have a place for you in the environment in 24? Because we know they haven't performed well this year.
I think if we take a look, for example, in the utilities sector, the utilities has had a difficult time because when the Fed is in the process of a Fed funds hike cycle, utilities, even though the regulated utilities should at some point get from regulators the ability to raise what they charge their constituencies to pay for the production of energy and increased costs. And to offset some of the factor that they are genuinely considered as bond proxies, or ultimately considered as bond proxies. So they sell off when interest rates are rising and inflation is going up. But once you get a sense that the Fed is nearing the end of a Fed funds hike cycle, as we and many others do believe, that's when all of a sudden investors start looking at utilities again in a more favorable manner. Similarly, we've seen the REITs, real estate investment trusts, begin to rally as a feeling is expressed within the markets that we've seen the peak in interest rates and are likely to trend lower. We believe that the Fed will likely remain on longer pauses through next year, reserve the right to raise rates if it feels inflation is sticky, maybe once or twice next year at most. But we don't think that the general trend will be to see likely a cut in rates, probably in the second half of the year and later in the second half of the year than many people believe.
All
So it'll
right,
take a little bit longer to get to that cutting.
John, always